Hello, and thank you for joining me here, Fiona Cincotta at StoneX. And today I have the pleasure of talking with Natalie Scott-Gray, who is Senior Metals Analyst at StoneX as well. Thank you very much for joining me today.
Pleasure to be here.
And so much to be talking about. I mean, this is a really timely conversation. Obviously, tariffs have been sort of front and centre of headlines over the last few days, weeks and months, really. So with industrial metals specifically targeted, what do you expect of the timelines for these tariff impacts to materialise?
So good question. And I think the first thing I have to say here is that the rate of change with decisions over tariffs is so fast changing to the point of Tuesday this week that they were changing on an intraday basis. So the landscape, as I laid out now, could be different by tomorrow, could be very different by next week. But if we look at the US tariffs that have gone into place so far, they have impacted China, Canada and Mexico. And then also specifically on metals, we're looking at aluminium and we're looking at steel. So Trump put 20% tariffs on China. This came in two installments of 10%. So we had 10% in February, 10% in March. But if we actually combine these tariffs of 20% with the tariffs already in play against China that are long-standing from Trump's first term, then we're actually looking at a total of 32% of tariffs against China as it stands at the moment. Now, Canada and Mexico on the 4th of March, we saw Trump move forward with 25% tariffs on all goods here, but he did roll it back a little bit 2 days later. So 6th of March, he made an exemption for any goods that fell under the current standing US-Mexican-Canadian agreement. So for the purpose of our industrial metals here, this actually exempted them from the 25% tariffs from Canada and from Mexico. But by the 12th of March, Trump moved forward then with 25% tariffs on steel and aluminium against all trading partners into the US. And we've seen this before in his first term where he did this over 2018, 2019, very briefly in 2020, but this time it's much more significant because it's not just the raw metals, but it's the derivative products as well. So we're looking at about $150 billion worth of goods that are going to be impacted. Now, retaliatory tariff-wise, we have seen China come back, we've seen Canada come back, and we expect that the EU will in mid-April. Now, the difference that we're seeing, which is quite interesting, is China's retaliatory tariffs are pretty modest. They're very highly targeted. So we're seeing 10 to 15% tariffs on energy products, agricultural products. They are limiting some critical minerals that the US desperately needs for AI. But it's Canada and the EU that have a larger impact at the moment. They're really doing this tit-for-tat trade war. They're matching basically the tariffs put on themselves dollar for dollar. So Canada has done two installments, the final one today, and that total of tariffs on US goods amounts to $41.5 billion. These are hugely significant numbers. And the EU is talking about $28 billion worth of tariffs in mid-April. Looking further ahead, as we have to do, the US has also promised more tariffs, and this is where there's a lot of speculation in the market. So the largest concern is the beginning of April. Trump has ordered an investigation to look at all countries that have a large trade surplus against the US. So here, China's got the largest trade surplus, but he's also looking at all countries that have higher tariffs against the US than the US has on them. He wants to balance that playing field out, whether that makes sense or not. So early April is going to be a pivotal time in the global markets, but also for our metals. And copper is another metal that is standing out for us at the moment. On the 25th of February, Trump signed an executive order looking into all imports of copper from all of its trading partners. Now, there isn't a specific timeline. It can take about 270 days in total for this investigation. So if you look on that as a base case, it's looking towards the end of the year. But concerns here have risen again because Trump spoke to Congress last week. I think the markets were pricing in about 10% tariffs. He was mentioning 25% tariffs on copper. So that supply risk is quite high in the market at the moment. And then other areas that he's looking to put tariffs on is lumber and wood, semiconductors, pharmaceuticals, Chinese ships, and also digital service tax. And the timeline for those can vary, or at the moment, of course, is not sure, as basically the situation is with tariffs at the moment.
Yeah, I mean, there is so much to unpack there. And as you said, there's been this sort of very much this idea of application or an implementation and an announcement of tariffs, then backtracking, then reassessing, reapplying exemptions, so much going on. I mean, we've seen that volatility really being playing out in the markets more broadly, stock markets as well, currency markets, but specifically detailing base metal markets. What have been the impacts that you've seen following the announcements on the base markets short term?
So, I mean, if we look at the base metal index as a whole, on a year-to-date basis, it's actually performed quite robustly. It's up about 7%. Now, some of those gains have arisen because of supply concerns around tariffs here, namely copper and aluminium. But largely the gains for the base metals so far this year has occurred because we've seen a pullback in the US dollar really since the beginning of the year. We've had talk about further stimulus coming out of China, which is really the heart of base metal demand. And also we've had tariff independent supply risks in the base metals. So for copper, there's ongoing shortages of ore. We've had it for nickel, where very low prices are causing cuts in the largest producing country now, Indonesia. And we've also got it for tin as well, where a host of these countries are facing various supply risks as well. So all of those factors have meant that the base metal index has lifted. But I can talk about the specifics for copper and aluminium, which is very tariff related. So for both of these metals, I'm saying supply risks. The reason why I say this is because as it stands, we've got that investigation going on, potentially imports going on, all copper imports going into the US. Meanwhile, we currently have 25% tariffs on all aluminium that is going into the US. Now, the US has a heavy reliance on importing both of these. That's why we have supply risks. So for copper, we're looking at about 45% of copper is imported in the US to cover demand. Huge quantities of copper scrap, copper products come from its two closest trading partners, so that's Canada and Mexico. Meanwhile, in the case of aluminium, it's much more acute, these supply risks. Not only are tariffs already in place, but the US actually imports about 80% of all of its aluminium requirements, and 90% of aluminium scrap, again, comes from Mexico and Canada. So the way that it's playing out is initially in the regional price or premia for these metals. So in the case of copper, we're seeing it play out in the CME LME price differential, or the spread. The reason why we're seeing it here is because the copper CME contract is custom cleared, number one, and it only has deliverable locations in the US. So this is very different to the LME copper contract, which has warehouses all around the world. So that it's playing out there. We have seen the spread rise above $1,000 per ton. We do expect that if 25% tariffs actually come into fruition, then we could see this shoot up further, potentially towards $2,000 per ton. In the case of aluminium, where these supply risks are playing out is in the US Midwest premium. And this is because the CME contract actually mirrors the LME's global location. So it's different to the copper contract in that way. Now, the premium here for aluminium in the US has hit a record level. It's above $9,000 per ton. And the premium is a cost that US purchasers would have to pay on top of the benchmark price if they want to get hold of that material. So we're looking at almost $3,000 per ton if you want to get aluminium into the country. So it's becoming very expensive. So that's the first thing that we're noticing. Supply risks are in regional premia and spreads. The second thing is in the physical market. So when you have a high premium in the US, of course, it's going to attract units into the country. Now, in the case of copper, that means normal trading partners, so let's say Canada or Chile, are going to increase the amount of material going into the US. But we're starting to see it play out on some of our global exchanges. So the global benchmark exchange, the LME, we have seen on-warrant stocks fall to 9-month lows. We expect that material is indirectly going into the US. And the reason why I say indirectly is at the end of February, LME stocks were made up 88% of Russian or Chinese brand copper units. Now, the US can't import Russian material since April last year, put sanctions against Russia, and it also has that higher tariffs that it's placed on all Chinese goods going into the country. So it's likely that this LME material is either plugging some of supply gaps around the world, but we do suspect a lot's going into the US is being swapped for US-friendly deliverable material. Now, as a consequence of this, is creating physical tightness in the LME market. And we have seen the cash to 3-month spread for copper flirt with backwardations. I say that because it's not holding necessarily in one, really for the first time since June. And there's a knock-on impact of this, that it means the Shanghai Future Exchange, so the Chinese domestic exchange, and the LME arbitrage is altering, and it's becoming more attractive for Chinese producers, smelters, to import material into the LME. And in fact, there was a headline yesterday that Chinese authorities are encouraging this move without taxes as well. So we're expecting about 45,000 tons of Chinese material to enter either bonded warehouses or LME-based warehouses in this month alone. So we had this huge global rerouting that's happening. It's also playing out for aluminium. Here, the high premium we expect will get more units coming from further abroad, so from India, from the UAE, from Australia. But Canada, because it's having this trade war with the US, and based on what we saw last time when tariffs went into play, those units from Canada, the biggest importer into the US, is likely to come into the European market and flood that market. And if you look at the premium globally for aluminium, we can see the US premium is shooting up and the EU premium is diverting downwards as a result. Now, the final thing that I will say is it's interesting to take a step back and look at what investors are doing or what they're thinking around these supply risks. Here I'm going to talk about copper, Dr. Copper. It reflects the health of the industrial market and the globe. Now, on COMEX, the net speculative positions are almost neutral, which is interesting. So we can see a net long of about 9,000 contracts. Huge difference from May last year when we had the COMEX squeeze and copper prices hit a nominal high. Back then, we had a net long of close to 75,000 contracts.
Wow.
So the fact that the positioning is neutral shows the concerns about what will happen to global copper prices as a result of tariffs in the longer term.
That's really interesting. As you said, sort of drawing on that Dr. Copper and what that means then for the outlook or concerns about the outlook for global growth is potentially actually looking, well, deteriorating from where it was. That's really interesting. I mean, obviously the short term we've talked about here and the tightness that we're seeing in the physical markets and the changes in pricing. What about the long-term impact of tariffs? What are the various scenarios that you see playing out there?
So let's say we're in a scenario where tariffs remain in their entirety or they continue to get worse. If tariffs remain on key producing countries to the US and of key producing countries of our metals, we'll see that supply concern continue to play out on those regional premia or prices. But when it comes to the LME benchmark price, it's going to reflect the health of the globe. And we see in the long term that tariffs, particularly retaliatory tariffs, they can cause shocks to global trade, shock to the global economy. That increases uncertainty, particularly when it comes to investment, and ultimately it leads to lower prices. Now, we've seen this historically. So if we look back to 2019, which was kind of the height of the China-US trade war under Trump's first term, we saw for the entirety of the year that base metals tracked pretty much in quite a tight sideways trading pattern. If we look forward to when Russia invaded Ukraine, so 2022, although the initial reaction that we've spoken about can increase prices, where we saw nominal highs of that time for several of our base metals because they were worried about what sanctions would do, there wouldn't be enough available material. If we look to Q3 of that year, when supply fears gave way to demand concerns, then the base metal index actually had its worst quarterly performance since the global financial crisis. Base metals were the weakest performer for that year. So it indicates that trade tariffs, rising geopolitical tensions is not good for base metal prices. It's not good for base metal demand. And I just want to single out our worst case scenario, which is increasing tariffs between China and the US. Now, we do expect that it is likely there will be more than these 20% tariffs to come into play. You know, Trump was talking potentially about 60%. We'll probably have to wait till April till we hear a little bit more about that. But China has the largest trade surplus to the US of any country in the world. It is also the largest producer and consumer of our base metals, so the health of China couldn't be more important. Why we're worried here in particular is because China's economy is much more fragile now than when it was in Trump's first term. So the biggest difference is that we've had the property crisis since then, which started in 2021. Now, property contributed to about a quarter of GDP growth in the country. At least 40% of household wealth is attached to the property market in China. And this is a reason why we've seen consumer confidence fall to record low levels. And it's just not been able to recover for at least half a year now. So the health of China is looking more precarious. The yuan is devaluating. Exports last year, China had to rely on exports so heavily that it contributed to that 25%, again, a quarter of GDP growth, where they did manage to hit 5%, but that was because of robust exports. If we see tariffs come into play, that's hitting China's exports. So any way that you look at it, if we have further tariffs on China, it is our worst case scenario for the base metal demand and also for the LME prices.
Yeah, you know, and it's so true what you pointed out there about the difference in position for China now as it was in 2016. And even, you know, the data that we see coming through, as you pointed out, the sort of PMI figures, even, they remain stagnant. You know, we're not seeing that recovery come through. But interestingly enough, last week as well, there was also the Two Sessions meeting in China, which is, you know, of huge interest, not just for the global markets, but particularly for the base metal markets as well. That concluded on Tuesday. And what specific outcomes and policy signals should market participants take away from the influence or that would influence the metals market?
So the Two Sessions meeting in China is actually two separate meetings. That's why it's called the two meetings, the National People's Congress and the Chinese People's Political Consultative Conference. And the outcome of these two meetings is really pivotal for the Chinese year, because we have economic targets that are released, you have personnel changes, and policy targets. It really lays out what we can expect for China, or what they want to achieve at least. Now, the stock market actually had a muted response overall to the main outcomes that came out for the economic targets. And there are positives and negatives to take away. So if we dive into that, the positives is that China wants to keep growth steady. So it set another 5% target that it achieved last year for this year. They are changing their policy where they want to focus on domestic consumption. They want to move away from export reliance. And they're going to support this growth by record levels of stimulus. So fiscal stimulus, the broad-based fiscal stimulus, is set at 8% of GDP for this year, so up from 6.6%. This is a record level, so that certainly is a positive in the eyes of industrial metals. Monetary policy was another area that we needed to point out, because the language here has changed very significantly. So monetary policy will be moderately loose. They haven't used the word prudent monetary policy, which has been in play for 14 years. So even though they're saying moderately loose, it's a big change in language. So again, here we could expect to have cuts to things like the reserve requirement ratio and the 7-day reverse repo rate. Other positives to take away, particularly for the base metals, is this focus on domestic consumption. They want to increase wage growth. And we haven't really heard comments around this before, but it's encouraging. They're moving towards high-tech areas, high-tech innovation. So think AI. We've heard a lot about that in the headlines so far. This is another way of China trying to move growth for the country away from its traditional drivers. So things like the property market, which unfortunately is still declining. So that's providing some optimism in the market. There was some talk about cutting overcapacity, which for the industrial market is very significant. It's one of the reasons why we're actually seeing cuts from smelters in metals like copper. And that's because the fees that they pay to the miners having to drop so low that they're not being profitable. Part of that is driven by ore tightness, but a large part is also driven because there's just so much overcapacity that competition is fierce. And the final thing that we took away as a positive is that they have mentioned they want to prevent further declines in the property market, but that is proving very difficult to do. And the level of inventory in the country, if we're talking out to tier 4, could take 5 to 10 years to buy up all of that inventory, but that's a separate thing that I'm sure we'll talk about at another time. The negatives to take away, in my view, what stood out was the fact that they lowered their inflation target. So it was set at 3% last year, it's now at 2%. The inflation target is more of a ceiling versus a target which you have for GDP, which they definitely want to hit that target. And the reason why they've lowered it is because last year inflation came in at 0.2%. That's miles away from the 3% ceiling. And it's very difficult to increase inflation in the country when consumer confidence is so low and they're not wanting to spend their money, even if savings are actually high in the households. So with that, it's concerning or potentially spelling out how China sees demand this year and how inflation may play out. And really, the kind of to wrap it up in our view, there just wasn't enough information on how this record level of stimulus is actually going to translate into achieving these goals. So with that uncertainty, to coin a term that I took out of the LME seminar last year in London from a wonderful professor who was talking about the economics, is that it's good for Wall Street, but it's not good for the person on the street. And I think that remains the case when we're looking at China.
Yeah, excellent. And then in light of the tariff pressures, obviously, that we've got that have been sort of announced, how's China positioning its industrial policy in the near term in light of those tariffs? And are there any signals that could suggest a shift in its approach to tariffs?
So we've seen tariffs be moderate and targeted. China do not want to see the relationship with the US further deteriorate. However, if we do have more tariffs against China, then I think they will come back with more severe tariffs. And that plays into our kind of worst case scenario outlook in the tariff environment. Something that was interesting from the Minister of Finance in China, he has said that the stimulus announced does not reflect the impact of tariffs. So therefore, he has said not only the pace in which stimulus is released in the country could alter, but the overall level could alter. So that means, I mean, it's encouraging that there could be further stimulus in China, but it would be happening because tariffs are increasing on the country, which overall, of course, is a negative.
Yeah.
I think the way they're altering their industrial policy, trying to move away from exports that they are aware are going to be negatively impacted. They want to focus on domestic consumption. They want to increase wage growth and promote these areas like renewable energy. You know, it's China's the leader in its field for spending, but I mean by volume as well as investments that are going into renewable energy, into electric vehicles, and now into AI. So they are promoting a turn away of growth areas from the traditional ones, construction and the property market, trying to go in a new direction. So there are positives to take away. There is an alteration, but we've got that worst case increase in trade war and tensions looming in the background.
Yeah, completely. And as you said, you know, those sort of huge shifts and changes in the way they're sort of looking to direct their economy, that takes time. it's not something that's achievable. And unfortunately, the tariffs and impacts from tariffs seem to feel like they're coming through thick and fast. At least we're getting the announcement through thick and fast. So yeah, it does feel like they're sort of caught in a bit of a difficult situation between the slow boat sort of shifting and trying to sort of fend off what's happening as far as tariffs are concerned.
Definitely, there's a difference in the pace of tariffs versus policy, and the rate of tariffs coming out of the US as well definitely is pretty historical.
And I guess beyond tariffs and policy changes, what are the immediate market indicators that we should be monitoring to gauge the health of China's industrial metal consumption?
So lots, I would say. I mean, if we're looking very metal by metal specific, then it's always advisable to look at trade numbers, what's coming into the country, what's coming out of the country versus what's being produced domestically in the country, and how domestic stocks are faring. So you can work out in a roundabout way the health of demand or production and how trade is flowing with respect to that. In the larger sense of indicators, it's worth looking at what the major end uses for industrial metals are. So for base metals here, we're talking about the construction market. That's made up of infrastructure, so that could be grid spending, state-owned buildings. We can see the housing market for individual property sales or investment, housing starts, housing completions. You might want to look at electronics demand, transport demand. How is the sale of vehicles going versus electric vehicles? Sentiment overall, however, I would say it's worth looking at those hard economic numbers that come out on a monthly basis for the overall health of China, because that can tell you a lot. Prices certainly react to that. And actually next week, we're going to get the large kind of data dump for February. Here it's where we get industrial production, industrial profits, retail sales, employment figures, fixed asset investment numbers, property sales, property investment. They all come out at the same time on the same day every month. You can get a lot from this if you compare it month by month, year on year, but particularly to where we were at the end of last year. Are there sectors that are outperforming? The trend that we've seen for a long time in China is that supply is outpacing demand. So industrial production is outperforming where we have been in previous years, but retail sales aren't, consumer sentiment isn't, and property investment. So this is for future demand in that very large area that ties into not only GDP growth, but consumer confidence, consumer spending. That's had continual declines for years. It is deepening. It isn't stabilizing. We want to see some stabilization there. So those figures do tell you a lot as well.
Yeah. No, loads to be watching then, definitely. And then just taking a step back, what does the impact of tariffs mean for base metal demand drivers overall, would you say?
So tariffs are a net negative overall. As we've said, it causes shocks to the economic system, uncertainty in investment, higher prices in regional locations, slower global trade. All of that is going to be negative for base metal prices. You could argue that we may see pockets of other areas of growth. So, I mean, when we had COVID, for example, there was an acceleration in green investments. Interestingly, out of that was a positive you could take away from that catastrophe. In this situation, as China is doing, also the US, there's a lot of investment going into the digital transition. So AI into data centers, it seems to be the new area of growth. So while countries are trying to manage the risk of tariffs, there will be ongoing investments into this new growth area. And for base metals, that's supportive for copper, it's supportive for aluminium, and it's also supportive for tin.
No, that's brilliant. Well, that is so much information that you've shared with us today. So thank you so much. We've talked about the short-term impact, the potential longer-term impact of trade tariffs, what's going on in China as far as shifting with their focus of their economy, and how trade tariffs are going to be impacting there. And then also what the broader impact is that we're seeing in the base metal market. So that's been brilliant. Thank you so much for joining us today.
Pleasure. Thank you.
Thank you. And for more analysis like this, then please do like and subscribe.